Hi guys, how are you? My name is One Titanium. Welcome back to Evidence-Based Economics and Investing. And in this video, we're going to continue our little economy that we started from scratch. And we're going to introduce banking into our little economy. So, really quickly, this is you. You started a country in the middle of nowhere. You created a government. You have a Fed, which is independent within government, not of government. And this is the bank of the government, and it prints money out of thin air, and the money gets spent into the economy, goes around circulation. Some of it is taxed back to be recycled for the next year's spending, and the remaining amount ends up in the savings bubble. Okay, I call it a bubble because I like to screw with the libertarians. Anyway. So that ends up in savings. Now, we're going to introduce banking. And as a lot of you already know, that banking produces the vast majority of the money. So, you go out, you borrow $10. A lot of people believe that, it's Jane's savings that you're borrowing and fractional reserve banking and so on. Well, it doesn't work that way. Banks also create money out of thin air. They are the agent of the government, okay? The agents. So they go out, they take a look at your application and say, yep, Bob is a good candidate for the loan. Here you go. Prints up money out of thin air. Gives them $10. That money gets spent into circulation. Some of it is taxed, and then it ends up in a savings. So forget about fractional reserve banking. It is loans that create deposits. Key words, right? Loans create deposits, not the other way around. Loans create deposits. Okay, good. Now, another thing that the Austrians and libertarians don't understand is they say, well, interest payments are bad and all this nonsense. Yeah, but remember that an interest payment is income to somebody, right? It is an income to the bank. And that income, and I shouldn't draw it all the way down here, that income ends up also in the savings bubble. The only requirement for a bank is that it holds less than 1% reserves in the Fed. Okay? That's it. The rest, what they do, is up to them. As long as they put that 1% into the Fed's checking account, Fed is happy, everybody's happy. And what's even better is that if they don't have those reserves to put in the Fed, then guess what? Fed would spot them the money, okay, till they do have it, and then they'll pay interest on it. So that's the way banking works. It adds fuel to the fire, if you will. Not that it is a fire, but it increases the size of the economy. There's more production, more consumption, and then ultimately that money goes into savings. The opposite of savings is what? Is debt, right? So if you have X amount of savings here, then you have to have an X amount of debt here. Right, and then they cancel each other out, and then we're good to go. So this is what we call horizontal money because it has interest associated with it when it comes from banks, right? And the loan has to be repaid back. And the deficits are net financial assets to the private sector. All right, very important to understand. Okay, we want more deficits, not so much more debt, or I should say more private debt. So before I end this video, I'll just finish it off with Steve Keen, and he'll basically explain how banking works. So let's get started.
Now, you've been writing on your debt deflation blog about the global financial crisis for years now. And you have a slightly different view about how the global economy and financial system works to the one we're used to, what we could call the neoclassical view from the likes of the Reserve Bank and the Treasury and the bank economists, who seem to say that debt doesn't really matter, that what's driving asset prices and the economy is the usual fundamentals. But you have a slightly different view about, well, quite different view about how asset prices have moved over recent years and why debt is important. Could you explain to us why you think debt matters so much?
The funny thing is I can explain it very easily to somebody who hasn't done an economics degree, and it's almost impossible to explain it to somebody who has. Because the basic story is, if I say to you, you're an individual, if you go shopping, you can go shopping two ways. You can reach into your pocket and pull out cash, or you can reach into your wallet and pull out your credit card. So your spending is going to be the sum of what you earn plus your change in debt. Now that aggregates to the national level. So the total spending in the economy is the sum of income plus the change in debt. Now an economist hears that and says, double counting. Because what's really happening is that when I increase my debt, it means that I've borrowed money from somebody, and the person I borrowed the money from therefore has less money to spend. So my increase in money in spending by borrowing is offset by somebody's lending to me who can spend less, and therefore you can ignore debt at the aggregate level. That's the logic they follow. Now that'd be true if you and I were, buying and selling by trading clamshells. There's only a fixed number of clamshells we've got, and you give me some of your clams, you've got less clams to spend, and therefore aggregate spending isn't affected. But banks don't produce clams. Banks use double entry bookkeeping, and they simply, the way it works is, I've got a certain amount of money I've saved, and my money's in the bank. You go to the bank and ask for a loan, and rather than saying, here's some of Steve's deposit, you can have it, spend it, burn it, and I go to the bank and find, hang on, I can't spend as much, which of course obviously doesn't happen. What in fact happens, the bank says, great idea, Bernard, here's $1 million. By the way, you owe us $1 million. Double entry bookkeeping. And the additional money they create adds to your spending power without subtracting from mine.
And what does this mean, though, for
what it means
asset
is
prices in the economy?
that then means that the total level of demand in the economy, is being the sum of income plus the change in debt, is then spent on both goods and services and assets. So you buy newly produced goods and services and pre-existing assets with that money. And that therefore means that the level of asset prices depends upon the change in debt. So to sustain where asset prices are right now, you've got to have the rate of change of debt being relatively constant with the rate of growth of assets. If you have, in fact, the rate of growth of debt being faster than the rate of growth of assets, you're going to get asset prices rising. And the fact that it actually causes asset prices to rise, if stable prices rely upon a constant rate of change of debt, then rising prices require accelerating debt.
So it's got nothing to do with income growth or migration?
It's got a bit to do with income growth and a bit to do with migration, but the major factor by far is the acceleration of debt. That's the driver behind demand.
So what happens when that debt acceleration slows down? In fact, you have
asset prices go down. All you're tracking with the change in asset prices after you get an asset which finally gets some sort of if you imagine a house being built and then it's improved, then you get rental income coming out of it and so on. Then there's a relationship between the rental income and the value of the property. But once you start getting speculation on top of that and people are playing flip that house, then what drives the house price up relative to the income that it can generate is accelerating levels of debt. So if I sell it to you and you borrow, with a loan to valuation ratio of 70%, and you sell it to somebody else who borrows to 75 and 80 and 85 and 90, that's what actually drives the house prices up.
So we've seen
Okay, so there you go. Pretty much what sums it up. Okay, that's it. In the next video, we'll talk a little bit about bonds. Take care. Talk to you soon. Bye bye.